Hi, this is Andrea with AccountWays, and today I'm talking specifically to new cannabis licensees. I understand that you are pre-revenue, and a lot of what I hear when I do talk to new licensees is, I'm pre-revenue, I don't need an accountant yet. But you have just spent a ton of money setting up your business entity and going through the licensing process. And then once you start building out your space, a lot of money is going to be going out the door very quickly on improving the space, adding fixtures, and on equipment if you're a cultivator or processor. And do you know how to properly account for these items in order to minimize your tax impact? So, what a properly trained cannabis accountant can do for you while you're pre revenue is one, get your books initially set up so that we can capture the money that you've already spent properly so that we can give you a better tax outcome in years to come. And I'm talking most specifically about startup costs and equipment costs. Certain startup costs can be capitalized under Section 195 and amortized over 15 years. And why is this important? Because you can't take deductions now because of 280E, whether you expense all of it in the year you incur it or if you amortize it over a longer 15-year time period. But if you're looking forward, eventually cannabis will be descheduled, and doing it right on the front end will set you up to be able to take deductions for some of the money you're spending today in future years after cannabis has been descheduled. So this might mean that you can take perhaps several years of startup cost amortizations once it's descheduled, depending on when it is descheduled. And also, for cultivators and processors, as you build out your space, you're spending money on equipment that's going to be used to produce your product. And you've probably been told cost of goods sold is allowable under 280E. And this is a little misleading because in reality, cost of goods sold is not a 280E deduction, but Section 471 allows for cost of goods sold to be used to adjust the gross profit number. But in order to do this, your books need to reflect proper full absorption inventory cost accounting. So this is more intricate than the standard cash-based accounting that most small businesses are able to get away with. And it is definitely not something you want to entrust to your uncle who said he'd keep your books for free because he watched a YouTube video on how to do QuickBooks. It's more involved than that. And the IRS has disallowed cost of goods sold deductions for taxpayers who are not keeping their books properly. So definitely want to get someone in on the front end as soon as you're buying your equipment to make sure that the accounting is done properly from the very beginning to maximize the benefit that you'll receive from that. And if you're a cultivator or processor, some or perhaps all of your building facility depreciation might also be eligible for inventory cost accounting as well. So me or another cannabis trained accountant can identify these assets and ensure that they're accounted for properly so that the depreciation on your equipment and building is built into your product inventory costs, making it eligible for a cost of goods sold adjustment to your gross profit number. So there's a call to action button on this video. Hit that call to action button. You'll be able to see my contact information, including a link to my LinkedIn, as well as a link to my Calendly to schedule a discovery call if you want to find out more about this. Thank you for listening and have a great day.